Hey guys, Tony Denaro here. Welcome back to the channel and happy Easter to you. I hope all of you enjoyed the 3-day weekend and you got to spend some quality time with your family over this weekend and that you're ready for an exciting trading week coming up. Now, some of you have been asking me over the weekend my thoughts about the Elon Musk and Twitter situation and if I had any possible trades I was looking at regarding Twitter coming into the next week. And so today, this evening, I'm going to spend a couple of minutes of time with you and talk about exactly that. Let's get right into it. As always, the usual disclaimers: I'm not a financial advisor. I'm not your financial advisor. The views expressed in this video are my thoughts and my opinions and things that I am thinking about doing with my own portfolio. Please do your own due diligence before you make any trading decisions. Let's get right into the information. A very quick recap on Twitter. At the beginning of April, it was disclosed by Elon Musk that he had accumulated a little bit over 9% of the stock of Twitter. The stock had been trading prior to his announcement in the range of $37, and on that day it shot up almost to 51 bucks. And in the past couple days, it has dropped down to $45. That was the close at the end of business on Thursday. The offer that Elon made to the board of directors of Twitter was for $54.20 a share. Now, if we look back on the one-year chart for Twitter, it has traded as high as $70 to $71 back in July. And right now, the board does not seem very interested in taking Elon up on his offer. There was some talk a week or so ago about him getting a seat on the board, and as you probably heard, he ended up declining, or for whatever reason, that did not work out. Now, on Friday, April 15th, we got another surprise announcement from the board of directors of Twitter that they had put in place a shareholder rights plan, also known as a poison pill, designed to thwart Elon Musk's attempt to take over the company. Now, in this shareholder rights plan, if any investor accumulates more than 15% of the company stock, the company would offer additional shares of stock to shareholders at a discounted price. The idea behind this kind of poison pill plan is to continually dilute the stock and prevent one investor from getting a majority stake in the company. Then yesterday, April 16th, Saturday, we got this tweet from Elon Musk, "Love me tender," alluding to the possibility of doing a tender offer directly to the shareholders. I have seen letters before with these sort of tender offers, and what happens is an investor that wants to accumulate shares in a company can reach out directly to the shareholders, either by a direct letter or through some sort of public announcement, and offer to buy their shares at a premium price from what the company is currently trading for. Whether or not that ends up happening is anybody's guess. And in fact, I've stayed on the sidelines for the last couple weeks in figuring out what I'm going to do with Twitter, because when Elon Musk is involved, anything can happen, and I don't like a 50-50 gamble. In other recent updates, if you have not heard, it was also disclosed recently over this weekend that Vanguard now has a 10.29% ownership stake in Twitter, slightly eclipsing Elon Musk's 9.10% ownership stake. To me, that's sort of irrelevant who has the most between 9 and 10%. There are a couple of different scenarios that are going to play out here. Either the board is going to accept Elon's offer of $54.20. He'll need to find the funding to buy the company, and then he intends to take it private. If you own Twitter stock, you'll be offered $54.20 for your share, and that will be it. You'll be out of Twitter stock. In the second scenario, the tender offer scenario, where he goes directly to the shareholders and asks to buy their shares, what I assume he's trying to do there, and I'm not really sure how that would play in with the poison pill provision, but if he is able to do the tender offer and accumulate enough shares, he could get a majority voting stake in the common stock, vote out the board of directors, and put in a board of directors that is more favorable to him. The third option would be that Elon gives up on Twitter and sells his stake. So with those different options in play and the timing being uncertain, let's talk about what type of trading opportunities there are with Twitter stock. I don't currently own any Twitter stock, but if you do own Twitter stock, I think there's two scenarios you should be thinking about if Elon is successful in his bid to take over the company, you're probably going to get a buyout offer at $54.20. And if he's not successful, then I would expect he will sell his stock and we're going to see Twitter fall back down into the high $30 range. So it's up to you to decide what you're going to do with your stock in light of those two situations. As for me not owning any stock, I'm going to be looking at some option plays going into next week. Let's take a look at those. As I mentioned earlier, over the past couple weeks, I've not taken any trades in Twitter stock because when Elon is involved and the board of directors is not on board, it's really been unclear to me what direction this stock was going to go. But now that we're 2 weeks into it and we have the shareholder rights plan put in place by the board of directors, that's good for a year from now, the poison pill. I think that in my view is more likely an outcome is that Elon Musk is going to give up, move on, and sell his Twitter shares. Again, this is just a guess. But based on that, I've been looking at some different long put plays. In other words, buying a put, betting on the stock to go down. Now, if your thinking is in alignment with that, you might consider buying some puts and betting on the stock to go down. And then really the question becomes, what is the time frame? Because that is going to affect the price of the puts that you buy and your overall return. Let's look at a couple of options. The first one that I have here up on the screen gives us 60 days and a $40 strike price. So we're betting by the 17th of June that Twitter will fall below the price of $40. This particular option would cost you $255. And if we guess the direction right, and by June 17th, Twitter stock were to fall to $35, we're looking at this very last column here, you would net a profit of $245. That is a 96% gain on your original investment. What you had bought for $255 would be worth $500 total. Now, obviously, if something happens sooner, we're looking over on the left-hand side of the chart. So if by, let's say, next Monday, April 25th, Twitter stock were to fall to $35, you would be looking at a net gain of $430 profit. That is 169% gain on your original investment. That put would be worth $685 on April 25th. Now let's take a look at a different option that is much cheaper if you think that something is going to happen in a lot sooner time frame than 60 days. A less expensive but much more risky strategy would be to buy a put that expires this coming Friday, April 22nd. And I'm going to keep the strike price at 40. So we're looking at a April 22nd $40 put. In this case, this put is going to cost you $62. And if by the 22nd of April, looking again at the far right column, Twitter were trading at $35, we'd be looking at a net profit on our $62 investment of $438. That is a gain of 706%. You would be able to sell that put for $500 and you purchased it for $62. Obviously, this is a very risky strategy because you're only giving yourself 5 days for Elon to make up his mind and announce that he has sold out his position on Twitter stock. There's a lot of other choices you could make to do a put option play on Twitter. You could pick different strike dates in May. You could pick something in August, September. It really depends on when you think something is going to happen between the board and Elon and a decision is made. But let's just look at one other scenario. If you got no money and you just want to YOLO, this is not something I recommend. This is a very, very high risk strategy. But if we did a April 22nd $35 put, that would cost you $15. And if the gods are in your favor and Twitter were to fall to $34 or $35 by Friday, this coming Friday, April 22nd, you would be able to sell that contract that you bought for $15 for $100 if Twitter hit $34 or $200 if Twitter hit $33. That's a gain of 567% or 1,233% respectively. As always with options, I recommend buying something that is at least 60 days out. It is more expensive, but you have a lot more time to be wrong? What if something doesn't happen this week and you bought that YOLO play? Well, you just threw your money out the window. On the other hand, I've presented you the choices. Ultimately, you have to decide what is right for you, your budget, and your own risk tolerance. If you have any questions, be sure and drop them down in the comments below. I'll be checking those tonight and trying to answer them as best as I can. Please join me on the live stream tomorrow. I do live stream during market hours. I'll be with you when the market opens. I'll also be with you during power hour answering your questions and talking about what's going on in the market in a variety of different stocks. And I'm happy to answer your questions. Don't forget to buy and hold that subscribe button if this is your first time here. I sure do appreciate it. And I will see you on the next video.
Question must have